Hey everyone, welcome back to Wealth Finance 61. Let's get into it.
Every banking crisis is described as a failure of stability, a sudden rupture in the financial order. Yet history reveals something far less chaotic and far more deliberate in its consequences. Institutions rarely emerge weaker from collapse, even when nations and citizens do. The mystery is not why crises occur, but why power consistently concentrates afterward. To understand this pattern, we must step backward into the architecture of modern finance. Banking systems were never merely commercial utilities exchanging savings and loans. They evolved as mechanisms for credit creation, leverage, and economic coordination. With that evolution came fragility, but also unprecedented political influence. Early banks operated within tangible limits imposed by metal reserves and settlement constraints. Credit expansion was restrained by physical redemption, imposing discipline through scarcity. Financial panics did occur, but their scale remained locally contained. Systemic dominance required something more elastic than gold. The 19th century marked a decisive shift towards centralized monetary authority. Lenders of last resort emerged as guardians against liquidity shortages. Their promise was stability, but their existence transformed incentives throughout banking. Risk could now be socialized, losses potentially absorbed beyond individual institutions. This safety net altered behavior in ways rarely acknowledged at the time. Banks expanded balance sheets, knowing emergencies would trigger extraordinary support. Credit cycles intensified, booms grew larger, and contractions became more destructive. Fragility was no longer accidental, but structurally embedded. The early 20th century provided the first global demonstration of this dynamic. Credit expansion, war finance, and speculative excess intertwined across continents. Monetary authorities attempted coordination without fully understanding systemic consequences. Stability mechanisms inadvertently amplified underlying vulnerabilities. The Great Depression stands as the defining rupture in financial memory. Thousands of banks failed, output collapsed, and unemployment soared beyond precedent. Conventional narratives describe regulatory absence and policy error as primary causes. Less examined is what followed the devastation. In response to collapse, governments expanded supervisory and monetary powers dramatically. Central banks gained new mandates, instruments, and political legitimacy. Deposit guarantees redefined relationships between citizens, banks, and the state. Financial authority migrated upward, away from dispersed private actors. The crisis did not merely reshape banking, it reconfigured governance itself. Economic management became inseparable from monetary intervention and credit allocation. Emergency powers evolved into permanent institutional capabilities. Instability justified centralization with remarkable efficiency. Post-war financial systems embedded these transformations into global structures. Exchange rate regimes, reserve currencies, and multilateral institutions reinforced hierarchy. Stability required coordination, and coordination required concentrated authority. Crisis logic became foundational rather than exceptional. Decades later, the pattern reappeared under new technological and regulatory conditions. Financial innovation accelerated leverage while obscuring interconnected exposures. Complex instruments diffused risk perception without reducing systemic vulnerability. Stability once again proved conditional. The global crisis of 2008 echoed earlier collapses with unsettling precision. Liquidity evaporated, credit markets froze, and institutions teetered simultaneously. Authorities intervened with measures previously considered unimaginable. Scale redefined the boundaries of acceptable response. Trillions were mobilized to stabilize balance sheets and restore market functioning. Emergency lending facilities multiplied across jurisdictions with extraordinary speed. Failing institutions merged, consolidated, or received direct state support. Survival hinged on access to central mechanisms. Once again, the aftermath revealed a familiar distribution of consequences. Large institutions emerged larger, smaller competitors vanished or were absorbed. Regulatory frameworks intensified, raising barriers to entry across financial sectors. Concentration accelerated under the banner of resilience. Public discourse emphasized rescue, recovery, and the prevention of future excesses. Less attention focused on structural reinforcement of institutional dominance. power shifted toward entities deemed systemically indispensable. Fragility paradoxically strengthens central authority. This paradox is not incidental, but rooted in crisis management mechanics. Systemic threats require rapid coordination and decisive liquidity provision. Only central institutions possess balance sheets and mandates large enough to respond. Dependence on centralized support becomes unavoidable. With each intervention, expectations adjust and behavioral feedback loops intensify. Market participants price risk, assuming extraordinary backstops will reappear. Scale advantages compound, favoring institutions closest to monetary authorities. Crisis response shapes future system structure. Data across decades reveals the repeating contours of this evolution. Banking assets concentrate into fewer entities after major disruptions. Central bank balance sheets expand persistently following emergency interventions. Temporary measures display remarkable institutional longevity. Modern parallels extend beyond banking into sovereign finance and market infrastructure. Debt crises trigger supranational oversight and conditional stabilization programs. Liquidity stress invites broader mandates and novel policy instruments. Authority accumulates through necessity rather than decree. Failed fixes often reinforce rather than dissolve underlying dynamics. Tighter regulation increases compliance costs, favoring larger incumbents. Moral hazard debates rarely alter emergency response frameworks. Stability concerns override structural reconsideration. The cycle persists because incentives align across multiple institutional layers. Policymakers prioritize collapse prevention over competitive decentralization. Markets reward entities perceived as protected by systemic importance. Citizens bear diffuse costs while benefits concentrate visibly. This recurring sequence reshapes economic landscapes with generational implications. Financial power centralizes without overt political confrontation or constitutional revision. Crises accelerate transformations otherwise resisted under normal conditions. Instability becomes an engine of reorganization. Three takeaways emerge from this historical trajectory with unsettling clarity. Banking crises rarely redistribute power downward within financial hierarchies. Emergency measures exhibit structural persistence beyond immediate stabilization needs. Fragility and authority evolve in mutually reinforcing patterns. The warning embedded in this pattern concerns visibility rather than inevitability. Systems designed around perpetual rescue mechanisms generate predictable concentrations of influence. Stability may improve, yet systemic dependence deepens simultaneously. Power migrates gradually, often unnoticed, until firmly entrenched. The open question is not whether crises will recur, but how their aftermaths will reshape authority. Observing these patterns requires sustained attention beyond moments of panic and relief. Understanding financial history becomes a form of institutional literacy. If this exploration sharpened your perspective, continue the inquiry and remain critically engaged.
Alright, that's wrap for today. Thanks for watching Wealth Finance 61.